So, hello and good afternoon. Welcome everyone to today's Trading Spotlight webinar on Friday, the 20th of March, 2020. Yes, well, the time is, let's call it interesting. Current developments in market are crazy. I've never experienced something similar, to be honest, in regards to market volatility, not even during the great financial crisis 2008 when Lehman Brothers went down. I hope everyone is fine, and I hope for us all that we will weather this storm. Probably the worst is yet to come, and now the thing is, we want to dig into a topic, and I just realized, I just realized, I realized that this is even more interesting right now than it probably would have been several weeks ago, because what we look at today, pairs trading, and market neutral trading strategies is probably one of the reasons of the current turmoil we get to see in financial markets. And what I mean with that will become clear a little later on, especially when we look at the current developments in treasury markets, US treasury markets, and here cash and the future market. Before we nevertheless come to this topic, makes sense here to have a look at today's agenda and then go through this, again, very interesting topic here. Step by step. So first of all, I'd like to introduce to you the idea behind pairs trading. Then I'd like to give you examples of potentially correlated pairs. So in fact, when I prepared this presentation here, my main focus was on equities. What you will see is at the end, we'll look at WTI Brent pair trading. So oil and a strategy for the oil market, a market neutral strategy, in fact. And as I already mentioned, we also want to have a look here at the developments in US Treasury markets, in fact, even though only from a rough perspective and only in a spoken way. So I do not have prepared anything in regards to charts to that or something like that, but it becomes clear where the risk of such pair trading strategies occurs and where it comes from, in fact. Still, before we dig too deep here into this topic, first of all, we'd like to give a simplified example and then characteristics of market neutral strategies, especially when it comes to risk management, because, and now this is something I'd like to say right from the start, in its core version, market neutral strategies usually work without stop losses, and you have to find other ways to calculate your risk. For example, something we've also introduced several weeks ago here in regards to value at risk. Probably some of you recall that, the gold trading strategy I presented, and that this is also an approach which could become necessary, respectively useful when it comes to such market neutral strategies, and probably is one of the reasons for the current extreme volatility in treasury markets. So before we come to this, that's me. My name is Jens Klatt. I'm located in Berlin, in Germany. And that's in fact all I'd like to say here in regards to my person. If you watch this on YouTube, then you will find the chance to click on the link in the description box below to an interview I gave to Admiral Markets that was in last year, June, July, so that you get an idea of where I come from, what's my academic background, but also what's my background in regards to trading. I work with the bank. And then I was a trading assistant for a very big broker here in Germany when it came to market making here in equities, for example. That was in fact shortly before the great financial crisis in 2006. So the great financial crisis 2008. But what's more important and very interesting, and right now is probably also a time where it becomes even more clear why you should definitely give a broker like Admiral Markets here a deeper look. Not only that they prepared themselves very professionally and in an extraordinarily well organized way here to make sure that customers do not face any let's call it service issues when it comes to their trading, but also when it, for example, comes here to the conditions you find in the financial markets in general. And when it comes to right now, for example, order execution speed, quality of order execution. So sure, you're not you have to handle the current situation as everyone else, and you probably face liquidity issues when it comes to widening of spreads. But still, when I look at my execution, I still get in such an illiquid market as the DAX, for example, currently is. It becomes clear why Admiral, for example, is referred to here in Germany among traders as the DAX expert, because you still get a very, very great quality execution, a very is it right to say speedy? So it's a very fast, quick execution you get, and slippage certainly is a topic, but this is given from a market perspective, liquidity perspective. But still, it's not that you say it's impossible to trade here profitably within this market environment. And that's one of the main reasons I highly recommend you right now watching this or watching the recording on YouTube, give Admiral a deeper look, because it's definitely worth it. Besides all the regulatory aspects here when it comes to regulation, FCA regulated, ASIC regulated, and all this. So that's it. Now let's dig into today's topic, pairs trading, and answer the question, what is pairs trading? So in fact, pairs trading is a very simple idea. A pairs trade or pair trading is a market neutral trading strategy, which enables traders to profit from virtually any market environment, uptrends, downtrends, sideways movements, something which is which does not depend on such things. Still, it depends on liquidity. It depends on liquid market conditions. Becomes clear what I mean with that a little later on. Others refer probably to pairs trading as statistical arbitrage. Probably have heard about this, quant trading strategies, or also convergence trading strategies. And the history behind pairs trading goes back to the, I think, 1960s, in fact. Some say that the pioneer of pair trading was a former trader at Morgan Stanley, Gary Bamberger, who implemented quantitative trading approach at Morgan Stanley's trading desk in the 1980s. But in fact, when you read the book, A Man for All Markets, that's in fact the biography of Ed Thorpe, one of the also probably most successful traders who have ever lived. He was interviewed, for example, from Jack Schwager in the book Hedge Fund Market Wizards. Ed Thorpe, in fact, traded this approach, pair trading or statistical arbitrage or convergence trading, whatever you call it, in the 1960s with his own earlier version of the Black-Scholes formula from 1972. So some of you probably have heard about this. This is the option pricing formula from two mathematicians, economists. I'm not sure about, by the way. I'm sorry, I have to say, I'm not sure whether they are mathematicians or whether they are economists. But the thing is that those two, in fact, only one, Fisher Black, I think, died in 1995, or was it Myron Scholes? I think it was Fisher Black. They received the Nobel Prize for economies or economics in 1997. If I'm not mistaken. And the interesting thing is that Ed Thorpe formulated such an approach. He's a mathematician himself. He formulated such an option pricing formula before Black and Scholes discovered their formula and published it, by the way. But instead of publishing it, Thorpe traded based on that. So he was too busy making money out of his formula he formulated or found himself. So the idea behind Black and Scholes is, in fact, you're finding a fair price for options. The fact that there was no such formula before could have led to inefficiencies when it came to pricing options or also warrants and their underlying stocks. And the inefficiencies here, if you spotted them, it's possible to make money out of this. It's like an arbitrage trade, in fact. It's risk-free trade to some extent. And so what Thorpe did, in fact, was already during the 1960s, he capitalized on inefficiencies between warrants and their underlying stocks, in fact. And Thorpe and Bamberger, after Thorpe learned about Bamberger, how he approached markets, what he developed here at Morgan Stanley, they formed, in fact, a joint venture after Bamberger exited Morgan Stanley, also during the 1980s. And yeah, that's the story behind this. So it goes already back to the 1960s, in fact, and is a very, very interesting trading approach ever since, in fact. And so what you, in fact, do is so nothing more than you try to find assets which are highly positively but also negatively correlated, or what we will later learn here is we call them fungible. Fungible. So it doesn't matter if you look at one or the other market. Or let's put it simply. For example, if you look here at Coca-Cola and Pepsi, for example, it becomes clear that both produce the same product, and they are both underlying the same supply chains, for example, the same market environments, which affects their overall profitability. Certainly, much comes down to management also, but all in all, when you look at it from a pure fundamental perspective, you have two assets here which produce the same good, and thus the equity or the underlying share price. What was this? 1 second. The underlying share price. 1 second. Let me just try whether this works. Yes. Should develop in a very same direction. Or if one asset sees a sharper push, let's say because of change when it comes to the management, CEO, whatever, and there's a large push in the share price on the upside, what you naturally expect is this move only to be short-lived, and the market dropping back to the current level, while the other share price in this fact in this moment is not affected at all. The same is also true when it comes to Renault and here, for example, a Peugeot Citroën, those two French automobile producers, I think we can call them. It's also true when looking at those big energy giants here from the US, ExxonMobil and Chevron Corporation, for example. Usually you expect both to underlie the same market conditions. Portugal Telecom and Telefonica, for example. There's also a German example. It's two energy giants here. It's RWE and E.ON, we call them. So, and also BHP Billiton, for example, and let me just see, yeah, BHP, yeah, in fact, nearly the same. It's BHP Billiton and BHP Billiton PLC, in fact. Usually you expect the same company, but under different regulations here to underlie the same market conditions. So what you naturally expect is the shares, the underlying shares of all these companies to develop in the same direction. And short-term discrepancies or inefficiencies within the share price due to again an announcement of the CEO being changed or stepping down or whatever, only being short-lived, and the market rather sooner or later push back to the recent, let's call it, fair value then. So therefore, let's have a look at the simplified example to make this really clear, in fact. Okay, yeah. Let's look at Pepsi and Coca-Cola here. Both obviously companies which are different, but they create a similar product. It's called soda pop. Okay, so then if PEP, Pepsi, and Coca-Cola are, when we look at this, this is what we call fungible, which means, or fungible, I'm not sure. So in Germany, it's fungible. In German, it's fungible. I'm not sure whether the right pronunciation is fungible or something like that. But it means nothing more than that their business success should depend on the soda pop market. And now, again, if for whatever reason, KO, in this case, Coca-Cola here, moves significantly up, while Pepsi, the share price here, does not move at all, a pairs trading strategy would expect the two fungible assets here and share prices to converge sooner rather than later again. And therefore, the strategy would be to buy the undervalued Pepsi share and sell the overvalued Coca-Cola share here in this case, betting on the two prices to converge again and to return to their historical, let's call it, balance point. So what's now of high interest in this regard is some of you might now say, yeah, but what if this does not happen? What if Coca-Cola does not drop in value again? Then what should naturally happen, or what the strategy bets on, is in fact that Pepsi will follow and rise stronger. And you're long the Pepsi share in this case, should show a sharper bullish momentum than Coca-Cola should show bullish momentum. So that means there's the option that Coca-Cola, the share price, drops back to the historic balance point, or that we find a higher new balance point, which means that Coca-Cola, once it stays at the same level, won't move at all, or moves slightly higher, while Pepsi then will start to gain stronger bullish momentum, which means also that you will profit from such a development, in fact. And that's the behind the idea behind this. And so the characteristics of such market neutral strategies means then that pairs trade help to hedge sector and market risk. For example, in case of a market crash, as you currently see, you see that the long position might lose, but the short trade going together with it should result in a profit, keeping the P&L of the position close to zero. So certainly it balances it out. Let's put it that way. Probably there's also a chance of profit. So there might be companies which have, or there's a consideration that one company has a better management than the other company, which means that one of the two shares should probably fall sharper in value then, in this case, than the other, which could also mean that even though you're nearly perfectly hedged, which is in fact not the case, and that's something we want to have a look at a little later on, and this could still result in a profit, in fact. And then we are not looking at the downside, but on the not on the upside, where Pepsi develops higher or stronger with stronger bullish momentum than our Coca-Cola share, but the other way around, in fact, that the company with a better management will not lose as much in value as the company which is considered not to have such a great management, or not such a great CEO, for example, or something like that. So now, pairs trading is something we call a mean reverting strategy. That means that we bet that prices will eventually revert to their fair value. So that's the basic idea behind this. And so pairs trade is to some extent a so-called self-funding strategy, with using the proceeds of the short sale to create the long position, in fact. So that means once you sell a share short, you receive, since you're selling something, you get the money, and you use the money to buy the long position in the perfectly correlated, positively correlated asset in this case, or negatively, but we will most of the time look at positive correlated assets in this case. So that's it, in fact. So that's the basic idea behind this. And now what we need to find is ways to not only identify a fair value, but also formulate a trading strategy to try to profit from that. I want to look now at coming from equities now to commodities, and here to WTI and Brent oil in this case, and look at the strategy first. And then at the end, or resulting out of the strategy, we want to have a look here at the problem which arises from the fact that we're not planning to work with a stop loss. So in fact, the strategy I present to you right now does not work with a stop loss, but we wait till this divergence is overcome again. So that's something we want to look at then in the summary, and then I take it from the summary to the current example in the treasury market, in fact, what's happening there, to just give you an explanation of where this deleveraging is also coming from, and why it adds further fuel to the current very, very tense situation you can find in the corporate bond sector, in fact. So first of all, let's have a look now at WTI Brent pair and the trading strategy here. So we look at two. Let me just 1 second. I don't like that. I do not know how to pronounce that. So it's fungible, fungible. Let's call it fungible. Okay, let's call it fungible. So we have two fungible assets. We have WTI and Brent oil. So that means nothing more than it doesn't really matter whether we use WTI oil, so Texas Intermediate, or if we use a Brent, in fact. So at the end of the day, our machine should be expected to work with oil, and it doesn't matter whether we take Western Texas Intermediate or whether we take a Brent. It doesn't really matter. So that's the basic idea behind that. So if you're now an expert on commodities, and especially on the oil market, you will probably shake your head and just say, okay, that's just not true because of this, and that reason. But to make things easier, let's assume they are fungible, and it doesn't matter whether we take one or the other sort of oil in this case. So now we have to find out which time frame we want to look at, and what we decide on is that the strategy we want to formulate here will look at a daily time frame, in fact. And now I'd like to introduce to you the trading logic. So what we do is we go long the undervalued, respectively go short the overvalued asset here. Once the difference between the so-called ratio, we have to define this a little later on. Once the difference between the ratio and the EMA4 on this ratio is greater 1.2, in fact. So if you program that, by the way, I've also programmed the basic idea in Python. Some of you probably recall that I was playing around with Python a little, also in regards to value at risk several weeks ago when it came to the gold trading strategy I presented to you. In fact, once you work with the data and you manipulate the data then to make use of it for you in regards to program, to write a program here, in fact, it will show that it's not 1.2, but this is for just illustration purposes, but it's 0.012, in fact. But this is just to let you know, once you now say, oh, this is a great idea, let me play around a little with this idea. So it's 1.2 for illustration purposes here. In fact, it's 0.012. Okay, so now we have to define this ratio and the EMA4 on this ratio, in fact. So the ratio is that you take the closing price of WTI and Brent, and that you divide the WTI closing price on the Brent price, in fact, and in fact that's it. So that's how you define the ratio. And then the EMA4 on the ratio means that you create an exponential moving average on this ratio with a target to calculate an average value of the closing price of WTI and Brent, in fact. So, and then what you do is that you wait until this EMA here, respectively, the ratio and the difference between those two drops below this threshold of 1.2, in fact, respectively rises above that. And what you do then is that you sell the overvalued price short, respectively, you buy the undervalued price, and thus create your, we can call this a hedge to some extent, and wait till this EMA crosses back above, respectively below. It depends on the direction here, below this ratio, in fact. And this is how you create this, in fact. How you open the trade. What you will find is that you now have a logic when you open the trade, respectively when you close the trade. But the thing is, we're not working with a stop loss here, because it could be that this, yeah, inefficiency or discrepancy or this convergence lasts longer for some time. In fact, again, we look at the treasury market in a few seconds and we'll see what I mean by that. And so it could be that the overall loss of the position, since the so-called basis, so the difference between those two prices stays not only open, but probably widens. That means nothing more than just imagine WTI keeping on rising while WTI, while Brent prices do not move and stay the same. Probably there's a reason for the demand being higher in WTI for whatever reason. Let's assume the US government under the Trump administration decides to buy WTI for whatever reason. Let's say they are scared to run out of oil for whatever reason, for example, and they plan to buy WTI here, while there's then certain high demand in WTI oil, while the demand should stay the same when it comes to Brent oil, or the other way around. Looking at the current price, probably it makes more sense to talk about dropping oil prices, but to make things easier, just assume that there's a higher demand for one sort of oil than for the other. And so that means that this so-called basis here could increase, which means that you have to stay within the trade here. Rather sooner than later, there will be such a convergence taking place, but still, you don't know how long this inefficiency will take. And that's why you're not placing a stop loss here in this basic strategy, in the core strategy. Yeah, and then, as I already said, you close the position once the ratio value crosses back above the EMA4 ratio value, respectively crosses below, depending on whether you crossed from below to higher, from below higher, or from higher to below and fell below that level or above. So, and so what I have here is now the result of the back test. In fact, once you do this during a time span from January 2000 till November 2016. Some of you probably wondered now why I took this time frame. In fact, the reason for that is simple. I had, first of all, only data available during this time span. Plus, in addition to that, this strategy was a strategy I formulated as a basic idea in my second book I published in 2018. It's, by the way, only available in German, so that doesn't make sense now to ask me what's the title. So if you're interested in it, and if you're a German, then probably it's of interest for you. It's called a Trader. You can only look at Amazon right now, Trader, and Jens Klatt, and then you will definitely find it. But it's in German. So just to make things clear here. And the strategy I present here is one I wrote down in the book. And this is the backtest result, in fact. It has a hit rate here of 73.5%. By the way, one thing, I have to mention that. That's very, very important. So the idea behind pair trading was already well known to me, but there was a physician, in fact, it was a PhD in physics who came up with this. He's also trading the market, and I asked him, so I know him from a former working experience, worked together with him also in regards to an account we traded together from a quantitative approach, in fact. And I asked him whether I'm allowed to use this strategy and present it within the book. So it's not the backtest result here and all the work which has been put in and in regards to the ratio, EMA4 of the ratio and everything like that is because of this experience and the allowance to use this here in my book. So that's very, very important to note here. So the hit rate of this approach, and again, of all trades being done, is 73.5%, with the loss rate obviously being the opposite. So it's 26.5%. The payoff ratio only, in fact, being close to 1-to-1, which means payoff ratio is the average gain of the trade to the average loss. And so we have still a max drawdown here. And where does the max drawdown come from? You can already see it here. It's based on the floating P&L. So what does this mean? Well, that is exactly what I just described. Just imagine you have a strong demand for a WTI, price is rising while Brent does not move. And now assume that you shorted WTI because it's overvalued compared to this fair price value you just identified, thanks to the ratio and the EMA4 on the ratio, and the market keeps on rising while while Brent prices do not move, and you're long Brent, which stays the same or volatile within the range, but range bound, let's say, while you see the asset you're currently short, WTI, the overvalued asset or the overvalued oil price being short and keep on losing money, at least on a floating P&L basis, in fact. And this is, you can see that the markets can extremely long stay, let's call it irrational, and develop far away from their fair value point, which means then that the loss could, to some extent, excess over 20% of your current equity, which becomes, by the way, a big issue once you over leverage the position. So the smaller the edge is here, and you can already see this. The main profitability of this approach arises from the fact that the hit rate is significantly higher than the loss rate. It's not because of the payoff ratio, and especially usually highly liquid markets, where there's lots of market depth available, many market participants trading. That means that so-called inefficiencies usually do not occur, and if they occur, they are usually very, very small. And this is something which you try to overcome then by leveraging your positions and using leverage here to get to a level where from a yield perspective, it becomes interesting. That's, by the way, one of the reasons, and we should have learned about this in the past already. We've seen it now, to an extent, which is potentially about to bring the whole financial system as we know it to the brink of disaster. Probably we are already beyond that point, and we're in free fall, and our whole financial system won't be the same anymore in several months from now with the drop in prices we currently see. And the only reason for markets currently stabilizing is probably because in hope that governments around the globe will step in and save the financial system as we know it. But let's come back to the topic here. So you try to leverage this, and this is a problem since you're not working with a stop loss. Here in this case, we're not hugely leveraged, in fact. So what we did here is we simulated, or we backtested the result with one future per position taken on the long side, a WTI future, and one on the short side, and assume, by the way, a so-called continuous contract. So probably some of you will say, okay, isn't there a problem once you have an expiration on the future contract then, because they usually expire every month? This is also something you need to take into account here. You have to look for a continuous contract, which is, for example, one of the reasons why it makes sense to you can also, by the way, formulate this trading strategy when looking at CFD prices. As far as I know, Admiral Markets is offering a continuous contract. So you can also trade the underlying future, WTI future, but there's also this continuous contract, which makes it possible for you to try to trade this strategy without having to worry to roll over your position to the next month, in fact. Plus, there's also something when it comes to risk management. One of the reasons we are using this EMA4 is that we avoid, by using such a short EMA, in fact, we avoid having a position open for months. So once this crossback occurs here of the EMA, in this case, back above the ratio, we close the position. So that's what we defined here. So once the ratio value crosses back above the EMA ratio, or the other way around, then we close the position. And that makes it possible to avoid positions which are open all the time. And by the way, this trade here, where we had this exceeding of over 20% of drawdown, which was the max drawdown, the trade, in fact, was closed with a profit at the end. So that's also something which shows that market can stay irrational. Still, it could mean that once you leverage to only a certain amount and stay conservative with this leverage approach, you could still face, even if you have a larger drawdown than compared to your overall equity, you could still see a profitable trade at the end, while working with a stop loss would in fact negatively affect the overall profitability of this pair trading approach. So let me just have a look here. Yeah, there are several reasons, or not reasons, ways to determine fair value. In fact, that's also something Vincenzo just mentioned. By the way, you're Italian. Do I read this right? I hope that everything's fine, not just for yourself, but also for your beloved ones. Okay, so and you're here. That's really great. So I really hope that you're fine, and all your friends and all your relatives and your family, everyone is fine. That's great to read. Okay, so let's now first of all sum all what we just learned up, and then I'll give you this short extension, let's call it, to the current market environment and what we currently see. So first of all, a pair trade, as we defined it, or pair trading, is a market neutral trading strategy, and it trades fungible assets against each other. For example, Coca-Cola and Pepsi, or also WTI, Brent oil, to give you already a hint towards what we will see in the extension. Also, we look at cash treasury markets and future treasury markets. So in this case, US cash and US treasury markets. The only problem which could occur, one of the problems, but it is very important from a risk management perspective, is that pair trading strategies usually work without a stop loss. So what could you do is that, for example, you use Monte Carlo simulations. We had this during the Trading Spotlight series here. I know that this was one of my topics. For example, you use the input. Now, we looked at a time span of 16 years. And so what we have is a hit rate, we have a loss rate, we have a payoff ratio, and we have a max DD, in fact. And now what we could use is we use the hit rate, the loss rate, and then also the payoff ratio, and we run such a Monte Carlo simulation. And what you can do then is that you can find a way, let's say you're risking 1% per trade, for example. What you could look at then, if you run the simulation several times and over again, then probably you will see that the drawdown hits a threshold which you're not fine dealing with anymore, or which you're not confident in trading or convenient anymore with. Which means, let's say the max DD, when having a hit rate of 73.5%, and you have a payoff ratio of 1.015 to 1, risking 1% per trade of your equity once you trade such a pair trade then in WTI and then Brent oil, for example, and you see your max DD during one of these simulations exceeding, let's say, 25%, then it means nothing more than, if you're not fine in seeing such a drawdown happening, which will naturally happen from a mathematical standpoint, then you have only one chance to reduce the risk of your trade, for example, and try to get to a level you're comfortable with, in fact. There's also the chance, another idea, to work with the so-called emergency stop loss, which can be formulated and set, or the position size can be adapted to fulfill the risk appetite of the trader. So in fact, as you may have guessed right here, I'm more a fan of working with reducing the position size and the approach, since the emergency stop loss, I can fully understand that, but all in all, and given the backtest results we just saw, it's probably better to go for the position size reduction idea instead of working with an emergency stop loss, since working with the emergency stop loss could massively negatively, especially, affect the overall profitability of this pair trading approach. So that's it on our pair trading, what I prepared, and now the extension. So what do we currently see? I haven't, again, that's very important now, and I just hope that my explanations are good enough so that you can really understand what I'm talking about now, because I do not have any charts, any graphics or something like that. I'm really sorry, but I haven't found anything of value in this case, in fact, which could help out here. So what do we see currently? You probably have seen, after all these coronavirus fears have hit the wire and resulted in this massive risk off, resulting out of the fact that governments around the globe are now shutting down their economies, tell people to stay at home, and try to somehow reduce the chance of an exponential growth of the infections with the coronavirus to not what's the right word for this? Overrun, yeah, let's call it overrun, overall overrun the health system, in fact. So we won't avoid being affected with the coronavirus, but we have to find a way to we have to get more time to make sure that the exponential growth is dampened and that our health system can work with this. And that's one of the reasons why it's so important to stay at home, right, by the way. So now, the thing is that you probably have seen once this coronavirus fears hit the wire, there was this classic safe haven asset approach which took place, which means then that in times during financial stress, market participants usually tend to buy US Treasury futures, for example, due to the liquidity, which naturally drives yields lower. But also, for example, you see gold prices rising, for example. You see equities dropping because there's a higher risk connected to equity prices. And so when looking at the developments in 10-year US Treasury yields in the US Treasury future, you will have seen that over the last 2 weeks, there was a low at something like 0.3% or something in 10-year US Treasury yields. There was a massive demand for US Treasury futures. And from there, when looking today at the chart, you will see that. Check out Market Watch and just type in 10 US. I think this is enough to get you the price or the current yield level. You will see that we're right now around 1%, if I'm not mistaken. It depends a little because we're already 40 minutes here within this webinar. And due to the lack of liquidity right now, you see just the markets jumping up and down like crazy. And again, moves I've never seen before. I've never witnessed before. And it's crazy, really, the lack of liquidity. So now the question arises, okay, wait a second. Why do yields now rise? Is the coronavirus fear not a topic anymore? It's the complete opposite. I think we all agree on that. Everyone is still not knowing what will happen in the future, especially now with economies completely shutting down. Our whole financial system about to collapse and probably have already collapsed, in fact. And so that doesn't make sense because you usually expect yields to stay under pressure in such an environment. You usually expect gold prices to keep on rising, for example. But instead, what you see is that while equities stay under pressure, also gold prices stay under pressure. And you see US yields rising. So what's happening there? And there we have to now look at a bond trading strategy, which comes down to, in fact, a pair trading idea. So what big investors usually do is they try to capitalize on a small difference within Treasury yields, US Treasury yields here. So what they do is, what's important is you usually see US Treasury yields, 10-year US Treasury yields, for example, to trade with a slight, what's the word for this? With a slight markup, to their cash equivalents. So what these bond traders now do is, in fact, since they expect once the Treasury future, the 10-year US Treasury future expires, that both trade at the same level. So what they do is, and due to the credit rating, they should expect these trade to play out over and over again. Since many market participants try to participate in this trade, the inefficiencies here is very, very small, but still given. So to profit from this in a solid way, let's call it, to present your investors a good return on investment, you leverage your trade, which consists of you buy the cash treasury, and then you sell the same amount in the future market short, and you pocket the difference, in fact. And by leveraging this trade, you usually can live quite comfortably with that, or respectively your investors. So now the thing is that what we've seen is, and this is what I refer to, the market staying longer irrational. What you've seen is, due to these corona fears hitting the wire, that there was a natural demand for a safe haven current asset in this case, which is the US Treasury. Which means you see, due to the liquidity aspect, you see a very high demand in US Treasury futures, which you usually sell within this trade. Remember, it's usually cash treasuries long and future treasuries short. So you bet here on this going up and the other going down, okay? But now you see US Treasury futures rising enormously in value, and this this base between those two is divergent. It's not convergent, but it's divergent, in fact. And so the problem now becomes the leverage, because the higher the leverage you use, the worse your P&L gets, in fact. And the widening of the spread rather sooner than later results in the spread widening to an extent where you have to then fire sell your position. You have to liquidate your position, in fact. So, which is then nothing more than, or by the way, in this regard, probably very important to note, you probably have heard about the issue in regards to the repo market. Probably you have followed this developments here, and that the Fed is willing to pump in billions, 500 billion overnight into the repo market. So why is this necessary? Because to get the leverage, these big players need to keep this position going. They're pair trade, in fact, they need liquidity, which they then use to leverage their position. And once they run out of funds due to the high leverage they are using, the Fed has to step in and to keep these companies alive, and else they just go bust. And so this is the reason why the Fed steps in and delivers the liquidity to keep this market as liquid as possible, in fact. But now, let's come to the thing. We have now a liquidity issue because these companies are forced to dump their positions, in fact. And not only that, the current developments have led unleveraged investors to step in, because the spread has widened to an extent that even trading this trade here unleveraged, so without using other funds than the funds you have yourself, has made it possible and profitable for those step into the ring and say, well, we are not leveraged, but we don't need to, because the spread has widened that much that we can profitably trade it here. The only problem is these investors, these, let's call them real money investors, they are also very active in the corporate world. And what do? When holding corporate bonds? They now identify a way more profitable trading idea or trade in the Treasury market, US Treasury market. And so what they do is they dump their corporate positions and they build UST positions to profit from this current profitable environment for them, buying cash treasuries and selling USTs, in fact. Which means now, coming back to the corporate world, if you have corporate bonds and you dump them, you sell them, this usually drives yields higher. So it's not only that you take money from these companies, the corporate world, away, which they currently desperately need because they have to somehow make sure that they still have a cash flow, that they have enough money available to keep their company alive, because currently there is no business being made because everything is in shutdown. So that means they take away this money from these corporate bonds here, from these companies, and they pump it into the treasury market, selling the futures, which means they are driving price, or yields in this case, for USTs higher. So that's, in fact, it's a little complicated to get through this, but it perfectly illustrates what issues you could run into when running such a pair trade. So when it comes down to the basic, that's exactly what pair trading is about. You have two fungible goods, so in this case US cash treasuries, and you have the future treasuries, and you trade them against each other. The only thing is, once the market dries out, liquidity disappears, and there is this base now widening, you then rather sooner or later run into trouble, especially when using leverage, which is why here it's so important to run such a strategy with an adequate risk and money management plan, in fact. So what we currently see in the real world is what here at first glance, and would have, if this catastrophe wouldn't have taken place right now, and it probably will even worse, will become even worse over the next months probably, is now something you can really see in the real world. So the pair trading strategy adds to the current danger of the whole system, which is of the brink of collapse, in fact. And that's it. The quick extension here of this summary. So now, after all this, don't forget to join us next time. So we're running out of time, in fact, a little, so I have to hurry up. Paul will be here same time on Monday, and he will teach you, in fact, how to trade through a crisis, including what actually constitutes a crisis, and how do full-time traders navigate such volatile environments. What should new trader be aware of when they now enter the market, in fact, and what are the learning points that Paul can pass on from past crises. I think the main topic here will certainly be the great financial crisis in 2008. So when it's 2 p.m. London, March 23rd, 2020, next Monday. If you're here right now in the live environment, then you only need to check your inbox for the registration link. If you now watch this on YouTube, you can head over to admiralmarkets.com and there navigate through educational webinars to Trading Spotlight. Register there, and yeah, join Paul for free and ask all your questions you might have. Admiralmarkets.com, again, feel free to look at the website, and here are the contact details if you want further information, and here's the risk disclaimer. That's it from my end. So all the best, happy trading, watch your stops, talk to you again next week on Friday. I look forward to it. Enjoy yourself over the weekend, stay safe, and all the best.